Hey, my name's Sean from Sean's Stock Strategies. Today we're going to learn about a well-known strategy from 1990, which is called Dogs of the Dow. So as everyone knows, Dow equals, so the Dow Jones market, that's their symbol, DJIA, and you can see that in Yahoo Finance, Google Finance, etc., and other stock traders like Ameritrade, Scottrade, etc. on the brokers. So you can get that stock quotes. So what it is the Dow Jones is the largest companies, dividend-only paying stocks, and traditionally before they invented the S&P 500, which I think is a better version of the market to kind of see where the market is, the Dow Jones represented all those stocks, and they just took kind of a market price. So if it was 100, they would add that, then would buy one with 10 and take one of that, and one of 20. So it kind of overweights on higher priced markets. So the Dow Jones isn't exactly a great market benchmark, but it is what it is. People have established it on the news, but I would really trace S&P 500. Now the Dogs of the Dow is, so every year, so on the last day of the year, 12/31, go through all of the Dow and find the bottom 10 with the highest dividend yield. Now, what is the dividend yields kind of goes and balance really based on, these companies will pay out really flat dividends. They'll pay quarterly about the same, and then they'll rise it a little bit and increase it, and then a little bit extra every year. Sorry, I did my glasses. So the dividends, will kind of be, on a lot of these guys, will just increase maybe 10 cents, then 20 cents, then 25, then 30. So they'll have this steady dividend, but with the stock price going up and down, here it's going to be really high dividend, right? And this will be a low dividend just based on the stock price. So this is stock price. So as that dividend is high, it's at a kind of artificial low, and since these are of the Dow Jones, the biggest companies, people think they will not go under. Now, the truth of the factor is out of the Dow Jones, the original, maybe from the 1880s, there might be one company left. They all have gone under. So long term, you can't use this long term. But because this is only a one-year strategy, you're only buying every year at December. You look at what's the bottom 10 and buy $1 of each. So kind of equally spread those across the bottom 10. And then next year, you're going to sell it off on 12/31. And then you're going to repeat the cycle. Look for the bottom 10 and then buy the first of the year. Hold for 1 year, sell. So let's look at last year, 2018 to 19. Let's see how it worked out in 2018. Okay, so we'll do this from 2016 to endward. So this is 12/31/16. So we have, in this case, we have Verizon at the top, Pfizer, CVX, BA for Bank of America, Cisco, KO for Coke, IBM, International Business Machine, XOM is Xerox, CAT is Caterpillar, MRK, I'm not sure. And we'll do the Dow Jones itself to compare. So here we have 53.38 for Verizon. Pfizer's 32.48. 1177 is CVX. 155.68 is Bank of America. Cisco is 30.22. Coke is 41.46. IBM is 165.99. Xerox is 90.26. Caterpillar is 92.74. and MRK is 58.87. So at the end of the year, next year, 52.93. So this is 2017 and 2016, right? So basically, percent increase or decrease. So basically flat, no gain. Pfizer is 36.22, so you gained 11.51%, so that's great. CBX is 125.119, so that's a 6.36%. That's a positive. Bank of America, 29491, 89.43%. This is a really big one. Cisco, 38.30, 27.4, so good there. Coca-Cola, 45.88, 10.66, pretty good. IBM, we have 153.42, so negative 7.57. So that one sucks. Xerox, 83.64. So another bad one. Caterpillar we have at 157. And it's a 69.92% return. So this is another great one. MRK is 56.27, 4.42% negative, so not too great. So let's compare that to the Dow Jones itself. So the return here is actually better using Dow Jones. So every year isn't a really great year for this type of thing. It does tend to outperform most years, but some years it definitely underperforms. It's really difficult to beat the market. So this is one strategy. Some years, let me just show you the years it wins versus loses here. So in 2012, dogs of the Dow, well, let's just do this by year. 2012, 2013, 2014, 2015, 2016. So dogs of the Dow, we're going to have 9.9%, 34.9%, 10.8%, 2.6%, 20.1%. Now let's compare that to the Dow Jones itself. So Dow Jones versus DD. So 2012, so in this case it was that winner. So in this case, dogs of the Dow won. This case slightly, dogs of the Dow. Here we beat it by about 2%. So 4 out of 5 years, the dogs of the Dow is going to outperform the Dow Jones, which is an 80% chance of winning. So I would definitely bet on the dogs of the Dow. And that's my explanation of dogs of the Dow. It doesn't always win, but that's my stock tip of the day, guys.